Thank you, Raleigh.
Thank you.
This is Gary Dean, and I wanted to start off. I have been following Woody Dorsey for a long time. I was a financial advisor, and that's how I first somebody I first noticed who he was, and then from there I read his book, Behavioral Trading, and I was just floored by the information that was in the book, and I continued to follow him. And Woody was primarily doing his information for the institutions. And after a few years, I decided to send him an email and find out if he would be interested in basically doing this more on a retail end of things. And we decided that was a good route to go, and that's how we founded Sentiment Timing. And it's a newsletter that is different than a lot, just because it's not really a trading type newsletter. It's more of a market timing, and a lot of it has to do with the triunity theory that Woody had developed, and it has to do with your where human behavior is the key determinant of the markets, and human beings in the markets are irrational, and there's always going to be an irrational element at work, and that's what creates market opportunities. And Woody is really the master of all of that, and it's a pleasure to watch him really work the markets, and he's going to explain a lot about how everything works and what goes on with it. So basically, the irrational elements, it creates market opportunities, and diagnosing these errors is the whole point of behavioral finance. And behavioral finance is something that's really unknown. They're just starting to scratch the surface as far as knowing how that all works. And Woody's the one that's really been kind of spearheading this entire movement. So, without further ado, I'm going to let Woody talk about the triunity theory, how it incorporates the mood, the mind, and the body of the markets as a whole. So, with that, this is Woody Dorsey, and he's going to take it over from here.
Hey, everybody. Yeah, I'm not a very public person, and I don't speak out that much about the market, so this is a rare opportunity for both of us. As Raleigh said, I've actually been publishing institutional research for 30 years, but I began my market studies 40 years ago, so I've been around for a while. And yes, I mean, markets have always been determined by the irrationality of human beings. It's not really a new thought. It was something that was academically proven by behavioral economics some 20 years ago. But those guys were not market people, so they never figured out how to apply it to the markets, which is what I do, because investors want to know what's going on with the market. They don't want a theory. Um, And what Gary and I are doing with the sentiment timing is I've taken a lot of the work that I've done over all of these years and basically focused it like a laser on relatively near-term trading opportunities to forecast the market. So instead of, the big picture, you can buy and hold the stock for 3 to 5 years. That doesn't help you if you are really involved in the market. So we have a very practical approach to what the market is going to do. Now, I did create the triunity theory, which is a practical advance within the behavioral finance modality. Do you need to know the theory? You don't. The point is that there is a whole body of knowledge and theory that I have developed in order to predict the markets. And it's good to know that there is that background, and there are parts of it which may appeal to you. You can learn more about it. But there is a theory, and it basically, when I say theory, I shouldn't say really theory, because it's a fact. It's a fact of how the markets work. The markets are only and always have been just a mirror of human beings. It's the same thing as a human being. It's a financial culture. And basically, just like human beings, the facts are There are three cognitive areas. There are three cognitive brains, and there are three cognitive brains in each human being and in the market. They're known as the fundamentals. Everybody's familiar with that. That has to do with the neocortex, actually the least important part of the market. There's the technicals, which you've all heard about. Some people are more focused on that. That's the fact of what prices do, and we'll talk more about that. The third component are what I call the psychologicals, which is the emotional brain. And you know what? Emotions don't really get very well covered because people just don't know that much about it. And if you study the last, 500 or 1,000 years of human history, you'll see that people just kind of really weren't into feelings. But feelings are very important. And that's what gives them a certain amount of power, is that I'm able to, having studied it, talk about sentiment, which are market emotions, and how important it is, again, in combination with the other two components. So basically, people are fascinated by the sentiment. I've been doing it for a long time, and one of the key components is I have a daily sentiment index for the stock market. Okay, I think today's sentiment was 68% or something after yesterday's kind of quasi rally. But at any rate, every day there is a sentiment number. And then I use various moving averages of that to look at, shorter term trends, longer term trends, etc. And also, which we'll show some of, to basically look at the micro tells that are individual daily sentiment to predict longer term market movements. I'm not trying to sell you a book, but in my book there are 2 chapters about sentiment. People just don't understand sentiment because there's Michigan Consumer, there's AAI, etc. The point is, I've been doing this longer than anybody, and I do it relatively precisely. But the bottom line is you have always got to interpret sentiment and try to predict the market from it. That's what we do. So here's an example of interpretation. This is going back in time to 2001, 2003 low. We'll show some very recent sentiment as well. But basically what you see here with this is that how there's a divergence between sentiment and price. It's just like a technical indicator in that regard. So again, what tends to happen is once really bearish ideas start to become fully reflected and discounted in the market, they don't have as much emotional power as they did earlier on. So sentiment divergence is one of the classic ways to interpret sentiment, not the only one. So now we'll look at some more recent sentiment. Okay, so now we're looking at recent market history, S&P 500, which is what we focus on, and I put up some individual daily extreme sentiments on here. So again, we see that when you get, like the 2% bullish in the market or 5%, we look at those, okay, that's pretty interesting. That might tell you that the market is getting sold out in combination with other technical indicators. It's a third lens of market diagnosis, very important. And you can see, and we've been saying this recently at the May high, there's a whole string of 90%, 92%, 90, 93% bullish sentiments. You see that, what does it mean? It means that the market is mature, that it's creating some kind of a high. So you see that, and we show this every week, twice a week actually. You have an indication. Would you want to take a big long trade when you see all that kind of high sentiment up there? You wouldn't. Does it mean that the market has to start a bear market? Doesn't mean that either, but it's an important indication. Now, one of the key things, and I'll show it also, there's a circle here. It's a circle between the 2%, the 2%. It's on the left, Gary, a little further over. That was at the April low.
Oh, this one.
No, the other one. That circle,
Okay.
just the circle over here. No, the circle it's at April. Yeah, very important. Okay, so the interesting thing is that that circle is from, I think it's the April 3. Now, what happened on April 3 is the market plunged in the morning. I believe that the S&P futures made a new low there.
They
Now,
did actually, yes.
But the point is it doesn't show in the cash market. nor did it show as a dramatic sentiment because the market recovered. The point that I made then is that that sentiment was a hidden sentiment that wasn't seen, but in reality, that I supposed was the end of a correction, of an ABC correction, and that therefore the market was resuming its uptrend, which is in fact what happened. So that's looking at the microtel of sentiment and making a price inference. So therefore, also, if the market rally, most recent rally began back on April 1, this rally is over 2 months old. That's very important from a timing point of view. Let's look at a little bit bigger picture of sentiment that we showed recently. Okay, so this is looking at a longer term moving average, 10-day. So you're just looking at a broad sense of the sentiment. And again, where I had the circle was also that April, near that April low. And again, you can see that the sentiment, probably just like different types of stochastics, but this is not a price-dominated metric. It's just a sentiment-dominated metric. So again, it's an extra reinforcing market lens on what's happening with the market. So this just shows you more of an
I have a question that would come up would be when you have intermediate term sentiment and then you also have short-term sentiment, say that are at lows, does that provide a better trading opportunity for a low or a high?
Oh, for a low. Now let's look at the big one again. Just go to the intermediate term. So, you know, if you're more of a position trader, let's go to the longer term. So if you're more a position trader, then you may want to focus more on the intermediate term and use the shorter term as an additional entry. So, you know, they're two different lenses.
I'm sorry.
Yeah.
I'm sorry. Go ahead. I was just going to point out how the intermediate term sentiment has been hanging around these high levels, and you've seen us just kind of chopping around. And one of the reasons is the, you know, where we're looking at with the intermediate term sentiment that is at high levels, and how you have thought that it was going to at least provide some kind of choppy tape, and that's what we've been seeing on it. So I'm sorry, go right ahead.
That's absolutely right. That's a very good diagnosis, is that because the intermediate term sentiment, as you showed, had sort of pushed up towards the high levels, and we had 3 or 4 days of 90, 92, 93% bullish on the daily sentiment at the same time. That's like a warning signal. This market should be trying to make some kind of corrective behavior, and indeed that's what's happened, and we allowed and warned for that with subscribers. You know, just leave this thing alone. Let's see what it's going to do. But there are some warning signals. Okay, let's go on here a little bit and see where we are.
All righty.
This is a lot of material here. So, you know, again, it's not just the sentiment. It's interpreting what the sentiment means in terms of levels, but also various types of psychological phases. And sometimes we get into really big price patterns, also based on timing. And this is one of the things where we thought back in August, and we're going to go look at this a little more, is that we had this thing that I invented that are called black holes, which are a big negative price magnet, which was due around October 13th of last year. So we knew that ahead of time. And again, we did have a very sharp fall into there, and we got very low sentiment there. So that's the timing modality coming to the sentiment. So in other words, it's the timing and the sentiment. That's why we call it sentiment timing. Let's go on a little further here, Gary, and see where we are. So I'm going to talk a little bit about market timing. You heard of market timing, but believe me, I've studied it for a long time, and there's a lot to it. One of the things that is in there in terms of market timing technology is what I call the trend duration analysis, which is how long do price trends last? We know that markets trend. In fact, the definition of a bull market is that it trends up more than it trends down, etc. So we can study these trend durations or attention spans, and I do that very, very carefully. That's one of the modalities. So for instance, I'll tell you something that you don't know, but informs what we've been saying in the letter. I've been talking about the global bond route. Am I surprised at what's happening in the bonds and the Treasury market? No. I think interest rates will be rising for 20 or 30 years. In fact, if you study your history, then you might realize that one of the last really great lows in interest rates was at the time of the fall of Rome, and interest rates rose for hundreds of years from there. So believe me, there's something going on here with interest rates. Now, some people thought, oh, the bonds are down a point today or 2 points today, stocks are going to crash. In reality, if you study trend duration and patterns of history, you would see that usually interest rates start going up and stocks don't care and they keep going up and people throw up their hands and this, that, and the other thing. It happened in 1987, for instance. In fact, when you study it, the classic trend duration mode of when interest rates start rising and when it hits the stock market is 8.6 months. You didn't know that, you know it now. What's the classic crash trend duration for stocks? Classic crash minimum is 1.6 months. That's a classic trend duration mode. That's what happened in 1987. So,
Hey,
but at
Woody,
any rate,
are there specific time frames that you look at for moves up or down? Is that part of the trend duration analysis that you use?
no, it is not. But I'll get to
Okay.
that, and that's a very good question. Okay, so the point is that I do a lot of timing research, and that's the other aspect with the sentiment. It's the second brain of the market, and so we have to search and research because the market is always changing a little bit. And one of the difficulties is you make a great call, which I have on the market, maybe 2 times in a row. People think you really know what the market's doing, like you're really in charge, and you're not. You know, so we have to have a certain amount of humility. However, markets do have an inner esoteric architecture in terms of time. Now, what I've discovered is the importance of the micro tells, very small expressions that are not easily seen but have inferences for trading. And I mentioned that low on April 3rd. There was a very important high that was made, I think it was May 2nd, 2011, where the market gapped up hugely on a Sunday night. And there was no, normally if that had been on a Monday or Tuesday, you would have seen a very high sentiment, like 100%. What happened? Osama bin Laden lost his life there. And that was a big market high. It went down for 3 months. That was a mini tell. But at any rate, in terms of time, it's a vast subject. I'm going to digress slightly just so you're aware of the degree that I have researched this over 40 years. Yes, most people are into what they call market cycles. Now, I studied Fourier transforms and cycle analysis at the graduate level. Okay. That kind of math is seductive, but it's misleading if you want to make any money. Yeah, there's things like the presidential cycle, there's this, there's that. In the older market language, there's the idea of the market being on a campaign and having sections within a campaign, and people study that like they study the battles in Greek wars, etc., because it all repeats. These cyclical phenomenon are recurrence. And that, if you ever wanted to know what W.D. Gann was talking about, he wrote a whole book called The Tunnel Through the Air, and that is the recurrence of timing patterns. One of the tricks I use, for instance, is to measure time backwards, not forwards. To look at old market campaigns, to look at when an important low is going to occur, like when the next black hole will occur, and measure backwards in time in terms of trend duration. Again, everybody wants to figure out the market, but it's not that easy. Yes, there are sometimes very plain vanilla cycles where the market does something, an index or a commodity might make a high every 12 days or lows every 23 weeks or something like that. Generally what happens after 2 or 3 instances of some kind of regularity, they just disappear. just when a computer probably thinks it's going to repeat. It doesn't. Now, what Gary was bringing up is the idea of seasonals. You know, there's a Santa Claus rally or Sell in May or whatever. There are sort of seasonals. But one of the things that I invented are quasi-seasonals. I invented it to describe that market trends that typically occur every year, but often at different times. So for instance, generally there's a 10% correction every year. So that's a seasonal, 10%, but it doesn't happen at the same time in the calendars. You can have these corrections, yeah, typically September, October, or you can have them in April or May. So there's a lot of things to look at. Now, there are also specific market signatures for different commodities and areas. So there's classic ones for energy. This is how I picked out the low in energy back in January, and there are specific market signatures for gold and other things. So that's an additional timing indicator. Then there are what you call turning points. That's where market energy is forecast to make an extreme. Often it can be determined if it will be a high or a low, but not necessarily. And again, the classic examples are the black holes, which are defined extreme lows, like we had last October, and we had in October of '87. And there is one coming this year, which if you subscribe, you will be made well aware of it. But there are also golden halos which occur, which are market highs. Like there was one in August of 1987. I think it was August 26th or 27th. That was a very important high, and I remember buying put options there because I was so smart. Yeah, I got the high. Of course, I didn't understand the principle of time decay, so they expired worthless 3 weeks later. But that's another story. At any rate, there are many combinations of these market timing factors that I look at, whether it's a high or a low, a soft high, a hard high, etc. And again, we combine these with the sentiment because remember, every market low, extreme market low, has low sentiment. Every market high has an indication of optimism. So these are the two market lenses. And then we use the traditional technicals as well. So those are some of the market timing technologies that are part of the sentiment timing research. So let's see what else we have here for you today.
Well, hang on one
terms
second.
of our
Let's
slide.
see if there's questions here. Okay. I think we're all set on it. I think the main thing right now we really want to probably touch on when you say you have your say multiple timing technologies to forecast turns and how there could be major highs and soft highs. How do you come up with the soft highs and say black hole lows and stuff like that? Do you combine that with say what overseas markets are doing with bonds, or how do you determine the if it's soft or a hard drop coming?
Well, you just look at the indications. There are some, just like there are some timing cycles which are intermediate and very extreme, and there's some that are that are softer. Like, well, that's just the nature of them. And so the point is, when you put it together and you see, for instance, like I talked about that in the newsletter, that this week was very sloppy, but that we could get negativity at the end of the week. So there were some indications of a short-term negativity, not a black hole, but short-term negativity. Here, I believe today is Thursday, and I think the market's having some trouble. So that fits in with this. Now, it's possible then that the market may hold here in the next few days and bounce back, and that would make sense because there's not a hard black hole market timing here.
Okay, and what about the say like when you come up with specific dates? Is that from your market timing technologies? Are they the ones that are forecasting that,
Yeah.
or are you using that from?
No, they're from the timing technologies, absolutely. Because
Okay,
that goes out
and if
into the future.
something, okay, perfect. Because and that's where what you'll do is if there's a turn coming, is that what you were saying, where you match them up with say where sentiment is at a particular time?
Well, sentiment it's like what was that thing that was in that movie? You know, that they had the Norden bombing thing in World War II that they invented to use on Japan, and they were always trying to figure out, you know, what it did, and it's just like it's aligning a series of different things. It's like GPS. If you know the latitude of something, well, it doesn't help you unless you know the longitude, right? So the sentiment is one brain. Again, it's an emotional. It's just like if you have an argument with your wife and she's very emotional, or maybe you are, she's very emotional. She may not be thinking as clearly because she's really dealing with the emotional brain. The thinking brain is a totally different brain. So the technicals and the timing are completely different brain than emotions. So you can't necessarily, you know, predict timing just from sentiment. What you want to do is see sentiment, which is more real time, align. If you think you've got a black hole projected, you know where it is in time. Then as you get into that black hole, if it's really going to be a really good black hole low in the market, is you're going to get some very low sentiment and some negative stories in the market. So it's confirming. It's not predict. You can't predict right now how people are going to feel about the market 2 weeks from now, but you can predict the timing, and then you see how they line up.
Okay. Now, I guess a question that's coming up is when you project that there's a black hole that is, say, pending in the third quarter of this year. How do you project that it's a black hole event and not just a
Well, you
regular,
want
say,
I'll tell you
small
what.
drop?
It's an open question. Why don't you or anybody else, you know, take the next 40 years and study market timing, and then you could probably come up with it. I
All
mean,
right.
you know, I
So
mean,
the next part, yeah.
yeah, I
I'm
mean, you
sorry.
know,
Go ahead.
that's what I do. That's what I do. I've studied these things. Other people have been doing other things, learning other things. God bless you. But this is what I do, and I've studied these things, and that's what I do. So,
Okay.
you
Excellent.
know, you've seen the
Excellent.
black holes before, so you know what I'm talking about.
Oh,
Go
I
ahead.
have. I've witnessed all of it. It's pretty interesting to watch, to say the least, on it. But so the next part, what we were really thinking about, Woody, did you want to add more on that end of it, or do we want to move over to the technical aspect of things?
I think we can move on, and then hopefully there'll be subscribers questions or other questions, so I can get into more detail. As I said, I don't do a lot of public speaking, and I'm happy to talk more depth. But why don't we finish what we have here, and
Okay.
then we can go further.
All right. Yeah. So really, what I do as far as with the sentiment timing end of things is I do the technical analysis, and the main thing that I really do is what I follow Woody's basically calls on. When say market energy is hitting whether there's supposed to be a high or a low. And from there, what I'll do is just do a regular technical support resistance. I look for divergences, and what that does is, on my end of the charting, it supports the call that we're looking for on a technical basis. So some of the things that I look for is I'm a big, say, a technical divergence technical analysis person. And what that basically is, it's when you have a price making a higher high while the technicals are making a higher low, that's your negative divergence. And from there, you would then be expecting the markets to move lower. And when price is moving lower while technicals are making higher lows, it's a bullish divergence. And I just really combine everything together. So for example, this is the when we were anticipating some type of low to hit, and the date was on the 920, which we showed you before. So an example of, say, a technical divergence is, here's your technicals moving down, and you can see the S&P was making higher highs. So we had a trend line that was going from this high to this high, and it actually hit exactly where it was on that. and it also came right within the time period that we were looking for the top to happen. So it was a pretty easy call as far as looking for the drop. And then we had the black hole event that was supposed to come in somewhere on the October 13th timeframe, and it actually came in right on schedule there. So if you were, the way that I really look at everything with this is when it was dropping, even though we didn't have the say a bullish divergence where price was making lower lows and the technicals are making higher highs, what I knew was we were very overbought right here and oversold. I'm sorry. And then from there, we also had a scheduled low. So we really, what I was doing on it, you don't want to get it really aggressively short on this end of it here because we were anticipating a low, and it actually was coming in right there, and we knew what happened after that. But another, say, technical divergence that may, hang on one second, I'm going to try and do this here.
I have something to add whenever you want me to say
Okay,
something.
go right ahead.
I should say it's a couple of interesting things that are right here. And this is also because Chuck had asked a question about options. And the reality is there's probably, a very few times during the year when you could really make a lot of money in options because of the time decay. And that's when you have big, fast moves. So I'm speaking to him, but in general, what's interesting here is the move from the 920 high to the 1013 low. That was 3 weeks. You could have made your whole trading year in 3 weeks on the downside. Big moves happen very quickly, and when you get to a black hole, you've got to get covered up. Now the other thing, so that's a trend duration is 3 weeks right there. Remember when I talked about the crash in 1987 was 1.6 months, but in reality, most of that move happened well after the high, and it was really about 3 weeks from early October to October 19th. So that's a classic little trading trend duration mode. Now the other thing when I talked about trend duration is if you look here at what happened is that basically when the market bottomed, it went up very quickly. That's a hallmark of a bullish market. In fact, it only took a few weeks to get back to the highs and then exceeded the highs. That was an indication. I talked about it in November and December. That low was a very good low. That was a low in a bull market. So sometimes we can look at past history and make certain inferences. And indeed, that's why the market has continued to kind of go up, because that was a very important low based on the trend duration of it going up quickly and it going up for longer than it went down. And that was the scary correction. It was only 3 weeks. So it's very important to look at how long certain trades take, and particularly if you want to be on the short side, an options trader, you make all your money very quickly, and there's only a few times of the year where you can really do that. That's what I just wanted to point that out.
Excellent. Thank you. And so basically, really the things that when I look at on these are, so we had our black hole event that took place here. We knew that we had a low that was pending. So if the thing is, if you got short up here and you made all these points in 3 weeks, what you want to look at is where is support on this, on the S&P, and you can see that in this area here, this was some major support. It could either go from the top here or the bottom here, and obviously it came pretty close to it. And from there, we had a say springboard move higher, and it took place right during the week that what the black hole event was supposed to end. So as far as like the technical analysis end of things, you want to know where, like, this is a weekly chart right here. So you want to find out where support is, where things may or may not hold. But the important part is knowing the time part, because when the S&P, I'm going to go back, when we first started dropping, remember, we just were making a series of higher highs, and nobody really thought this market was going down. So once we got to the, say the first support level and that broke, you had everybody buying the second support level, which is really just a moving average end. But if you didn't combine the time, if you were buying these dips right here, then what happened was you were just setting yourself up for the really to be trapped on the long side and most likely selling at the panic low. So the combining both, say the technical aspect of it as well as the time that Woody provides gives you say a trading advantage, because you would have known that, listen, that the black hole event's not supposed to hit until the 13th, and we were only in September 26th here. So everybody that was buying was just being set up, especially this candle right here where we had the huge reversal. Everybody thought the lows were in. We didn't have any bullish divergences really supporting it. It was at support, but the time-wise, we still had another almost 2 weeks to go before the low was hitting. So you knew, not to buy that end of it. So the big part of really the technical analysis part is to match that up with when timing is supposed to, when we're supposed to either be making some type of top or some type of low. And each one of these big moves here, there was a low date and there was a high date, and you can see we had the bearish divergences in place. So the trades were fairly, they were cut and dry on it, and these moves have been just absolutely massive. So the big part that you really, I think, with technical analysis and with whatever you use as far as support and resistance, is knowing when to actually expect that low or the high, because these say bearish divergences or bullish divergences, they're a lot of times everybody's using them now, and it's becoming very mainstream. So when it becomes mainstream and everybody knows how to do things, the pros take advantage of it. And I think one of the prime examples of that would be Elliott wave counting. It was not really known that well in the past, and what happened was everybody jumped on board, and now what happens is it's very difficult to come up with any kind of real wave count, and the pros are using those against your bulls and your bears that are looking for these big moves. So unless you know the time period that the lows and the highs are going to make, a lot of the other indicators and everything else you follow, it will fail. And if you get them both combined at once, where you have a bearish divergence, you have a top that's supposed to be made, then you can take a pretty high odds on trade, especially if sentiment and everything else is aligned up here. And the same goes with the lows here, where sentiment was at extreme lows. We had a turn date that was there, and as I showed you here, we were approaching support levels. So buying these, you really,
Right.
in a matter of a 6-week time frame, you had massive amounts of points being made. I'm sorry, go ahead, Woody.
Right now, I just that's very good. I just have a couple of other comments. Also, to Chuck, who wrote in, he was absolutely correct. Is that basically, as an option trader, the big money was made on the downside, and even more so on the upside from that black hole. And it's interesting to think, if you look through a year or whatever, at various markets, is that there are opportunities both ways, but not necessarily every week. And so you really want to take advantage of when things line up with the timing. But I also wanted to say that just like this black hole here, that, it was very, very important. But when you look at the low, that's this period of history, I'm trying to do this with my pointer here. This low was also a very good low, and you can just see, looking at the price history, that it was corrective, but it didn't go anywhere. So looking at a market is a misunderstood skill set, because a lot of old masters you look at the price of the market. You don't need 100 indicators or this, that, or the other thing. Look at what it did there. It was clear that it was trying to correct, but didn't do so very well. Turned around, went higher. Now, the interesting thing, and I know Gary's talked about this in the report as well, is that look at what the market has been doing during this period. It's some kind of rising wedge. It's very squirrely. It's very confusing. This is more typical of a market which is running out of room on the upside. And just by visually studying the market, you can get a sense of that. So it's very important to just try to look at the market also in a simple way. Sometimes we get overthinking, and I've written more about this and talk more about it. But it's basically you want the market to become more transparent to yourself. And if you, I mean, I used to be when I go into these Wall Street places, and I sort of felt that I had some guys that had 10 or 12 screens in front of them, and I thought, the more screens you have, the less you know, because it's a distraction from seeing the real market. You need to look at what the market is doing, and that can be very revelatory.
I think another thing, Woody, that I'd like to add is that one of the I talk about this a lot, where with the computers and how everybody's able to look at their portfolios at basically every second of the day, it's created a different type of emotion in the markets. And the thing is that I'm finding a lot with a ton of traders, whether it be on the other site or even questions that come in from Sentiment Timing, is how come you're not making, we're not making any trades lately, or you're not recommending? And one of the things that I talk about a lot is everybody feels like they have to be in the market every single day, every single minute. And the more trades you make, if you don't have, say, a good high odds trade, like something that was taking place here or here, and you try to force feed trades, what happens is people get frustrated. And I've been seeing that with just regular emails that I get from other newsletters. I don't know how I got on their list, but everyone, they're sitting there talking about the markets breaking down or this, and there really is no certain important energy date that's due for any time soon. So forcing it up or forcing it down, what's happening is people are getting stopped out on shorts, and they're getting stopped out on the long side. And really the primary reason is they're trying to force a direction in the market when it's directionless right now. We're not going anywhere, and everybody's thinking it's breaking down, so they're jumping on the short side, and then from there they're spiking it back up. And we know when the energy date is coming. If we have divergences, then it will maybe a short trade. If it's a low going into it and there's positive divergence, then it's going to be a long trade. But the thing that really is important is just being patient with the market and waiting for a setup, because when you try to force feed trades, you're going to end up getting caught on the wrong side. And when you lose money, you get frustrated, and from there you miss the actual trade that's been waiting for a few weeks.
No, exactly, and it's a good point. It's what I call that you have to preserve your psychological capital, because if you make losing trades, you've lost psychological capital because you get concerned. Now, great traders like Paul Tudor Jones, who I was very involved with, one of his key trader, but he'd make like 10 trades and lose money on 9 of them, and the 10th one he'd make a boatload, because he was a professional trader and he just knew how to stop out real quick and get back in. For most of us, that's pretty tough. So psychological capital is very important to maintain, and to be aware, like you said, is that sometimes the markets are just not offering a great edge, and to be aware of that. Absolutely.
So if you were going to sum up, what would be, like, let's say if we're for everybody that's listening right now, what would you say would be the most important aspects that you would say you need to follow to be a successful trader?
Well, first off, I would say, as I say, this is, this is not really a trading service that gives you trades. This is an insight-based based on my experience, that gives you an extra edge about what to expect. Because there are people who are going to be trading options on this, would like to trade options, but they may do it with iron condors or spreads. I mean, or they may be doing it with futures, or they may be very, new at the game and they're going to buy short IBM, whatever they're going to. People trade in a lot of different ways. The point is that if you want to be involved in the market and try to make money, the more insight and information that you have is useful, particularly if you're not getting it anywhere else. And I happen to know, because I've done this a long time and I've been involved with a lot of really big traders. I have a very good insight into the market. Doesn't mean I'm right all the time. I read an article, I wish I had it years ago, about one of these guys who was he worked with basketball stars. He was a shooting expert. They had trouble with their shot, so that you never heard of this guy, but it was his profile. I said, I wish I had it. So he'd go out, he'd be out in the court, just him and Scottie Pippen or whoever it would be, having a little trouble being short or left or right off the rim. And he said, he would take these shots. He said, he basically he never missed a shot. He could just hit a shot all day long because he understood the mechanics of the basketball shot very, very well. Did he play for a team? No, he couldn't play basketball, but he understood the shot, and he helped these people correct their shooting mistakes and become great shooters. That was his job. Just like, Sean Foley or one of these different golf coaches. I mean, these golfers have tons of people helping them. Yeah, at the end of the day, you see them out there, making the putt or not. But basically, they seek out expertise about how to do things. And that's what I see my role is. And like you had said before, I think waiting for really great opportunities is part of it.
Hey,
It's
Woody,
part
I
of
know.
part of
I'm sorry. I
yeah.
thought there was a delay on it. There's somebody. Sal just asked a question. He's going back to the sentiment, and he has,
Yeah.
what specifically goes into the short term and intermediate term sentiment measures, i.e. what data, stats, and I think that has to do with going back to the polling end of it. So I think he just has
Yeah.
another question on, that was the question on that, is what
Yeah. I see
goes
it.
into
I see it here.
picking these.
Yeah. Well, again, the two measures with the blue lines are simply two different moving averages of the daily sentiment. Everything is based on the daily sentiment. I think it says on there it's a 6-day and I think a 10-day, and I have 20-day and 35. There's a lot of different moving averages of that. So there's only one piece of data, which is the daily sentiment, and that just gets smoothed. But like I find in the intermediate term, which we've been using, that I believe is the 10-day. I don't know if you can show that one. Has been a
Hang on one
pretty
second.
good indicator, of the kind of the general trend. Again, I recommend to Sal or to anyone. I'm not trying to sell books, but I've written a couple of chapters about sentiment that in my experience, is the most complete exposition of this particular area of the market. So you can see here on this graph, thank you, it says 10-day moving average of the Dorsey market sentiment. So the blue line is just 10-day moving average. It's a simple moving average, not exponential. I've looked at that, et cetera, et cetera. That kind of gives you an indication. Even in this weird choppy market, you can see that it's given you an indication of where the sentiment is. So the book
And
is
is
called
there?
Behavioral Trading. Yeah,
Yeah,
Sal's
I'll
asking.
send them that.
Yeah. Okay.
Yeah, I'll send them that information.
Because I think if you're interested in, again, sentiment is the third lens of the market. People don't understand it. People don't study it. It's just as important as technicals, just as important as what I call the fundamental themes. But it's something that I had made a study of, so it's good background information. Here's the thing
Does
for you
anybody
that's
else have
quite
any?
interesting.
I'm sorry. Go right ahead.
That's what I was going to say. What's interesting is that, which I didn't talk about in here, but a lot of times I look at what I also call where the sentiment is located, and also the sentiment torques. So, it's interesting, like at the end of May, we had like not 3 days in a row, but pretty close together with very, very high sentiment. The important thing is that high sentiment occurred after the market had already begun a move. It was already mature from a trading point of view. So when sentiment occurs is very important in terms of identifying is it a potential low or not. And I say that, the market had already moved up. I say that because if the market has been correcting and you see some the market has been correcting and you get some low sentiment and then a couple days later you get like 90% bullish, that's what I call a sentiment torque, because it shows you the sentiment has just reversed from being pretty negative to positive, and that's actually a bullish indicator. So 90% bullish isn't necessarily a bearish thing. It depends on where it's located relative to price history.
And
So
it's
there are,
something that I pay attention to too, is when these charts come out, is where and when sentiment is hitting these extremes. And it's whenever I've seen a series of these of the high 90 sentiment readings, what it's basically telling me, even if we've made some kind of a drop or whatever, it's not something you want to be chasing the long side on. And it even though it may not mean it's a top, when you start seeing a series of them, what it means is, do you really want to be jumping on this bandwagon when we've had this many bullish sentiment extremes that have been registered?
now I see Steve has a question, and again, the data behind the sentiment index is the proprietary daily sentiment that I collect. I've been collecting it for 30 years, and it really is what is the sentiment right now. It's not what do you think in 30 days or 90 days or whatever. There are sentiments that do that, but they're not really sentiments, because then somebody's got to start thinking, gee, maybe this could, that could happen, and it gets mixed up with the other brain. And so it's just this daily sentiment. What's quite interesting is that what could eventually happen in the future or whatever is there's a again, to me, how the market closes and what happened is very important. So there are days like that day in April 3rd where the S&P futures made a dramatic new low, but actually the cash market was closed that day, but the futures came right back. That was de facto extreme low sentiment, even though it's never going to be recorded that way. And there's something called ecological momentary assessment. It's complicated, I know, but theoretically, you could take the sentiment every 15 minutes if you had a way of measuring that. But ultimately, this daily sentiment, how does the market feel today at the close, is very, very important. But that's all it is. But again, people are fascinated by data, and I've gotten this from people like, gee, what's your data? What good is it going to do if you don't understand the whole idea of emotions in the market, and if you cannot use the principles of interpretation? Because the data by itself, it'd be like me saying, well, IBM has a price to earnings multiple of 11. That's a great piece of data. So what? Do you buy it? Do you sell it? I mean, it's just a piece of data. You need the understanding, and you need to put it together with the technicals like Gary is talking about. Let's face it, the markets are hard. It's an art, and so you've got to put a lot of things together to try to come up, with the forecast. And God willing, if you can get a couple of really big trades, during the year, you can do very, very well. And if you're in the market a lot, you can make smaller trades all the time, as long as you understand, could this be big, or when do you want to be short a little bit, when do you be long a little bit? Then you get into trading, which really has a lot to do with risk management, position size, etc. But you want to try to see. People say that they're interested in the market, and I get this all the time from these hedge funds or whatever. And I would sort of say, tongue in cheek a little, yeah, but are you really interested in understanding the market? because that's a whole field. That's a little different than trading. So I'm trying to provide a kind of understanding of some of these nuances that, will help you in doing what you do.
All right, Woody, that's some great information. I know it's a little bit different than the previous moderator as far as giving the specific examples on how those trades are made. But the sentiment it's a unique and the behavioral trading is a unique way of looking at the markets a little bit differently. And is there any other questions that are out there that we might be able to answer? All right. I'm not sure. I'm pretty sure we're done on our end here.
Steve has another question. Steve, okay, very good. You said you heard the words. Yeah. I'm referring to something as sentiment, and what it is from the polling every day from human beings. How do they feel about the market? That's what it is. It's not technicals. And in fact, what I call the sentiment is kind of like technicals are based on the price bars. The sentiment is a totally separate indicator. What I'm going to try to do here is look at something real quick for you just to give you an example. I'm looking at my sentiment database. So for instance, today's sentiment coming in was 67% bullish. 67% of the people polled thought the market was good. Okay, the day before was 39% bullish. So the market had been down the day before. Then it was 74%. Every day there is a sentiment number that is based on the percentage of people who like the market or feel that the market is good. See, we had 90% bullish on May 28th. That was the day after we hit 2126 on the S&P. And that could go back 39, 90, 41, etc. Okay, I'm just giving him an example.
Sal just asked we're closing up here soon, but Sal just asked a question because you've actually brought this up about the DSI.
It's my again, I would read in the book. This is my sentiment. You've never seen it before. There's no one else who has it but me. And I started collecting before all these people. Believe me, I know. DSI started collecting way before them. But again, I have the data. Fine, other people have different sorts of data. Weekly data is useless, but it has to be interpreted. Okay.
So I think that's pretty much that's all we have. We have an offer that if you guys are interested, we're giving the first week free. It's a trial, and then 50% off for the first month. You'll get a pretty good idea as far as what how our sentiment newsletter reads, what you get out of it. It's not something that you're going to be able to day trade off of. This is information to know how to position your trades, how to know when to expect when the next turn is coming, and really look at the markets through Woody Dorsey and how he views them, as well as these sentiment indicators. So if you are interested in giving this in seeing the markets through the eyes of Woody Dorsey, we're going to let you have the first week free. And then if you decide to stay, it's 50% off for your first month. So you just need to click on this tab right here, and that's about it. That's all we have for today, I think.
Yeah, if you want to know when that black hole is, it's coming. You can make a lot of money. It's not this week, but it's coming. So stay tuned. Hey, thanks for listening, everybody. Okay.
Thank you, everybody.
Cheers.